Welcome to the deep dive. You've probably seen those big headlines, right? Giant corp buys small startup for billions.
Happens all the time.
And, well, if you're anything like me, you might wonder, billions? Seriously, what are they actually paying for? I mean, beyond the obvious stuff like laptops and maybe some office chairs.
What's the real value there?
Exactly. And often, a huge piece of that price tag, it's not for things you can touch. It's for this fascinating and sometimes kind of mysterious line item called Goodwill.
And that's our focus today. We're going deep into Goodwill in these business combinations. You know, what it actually is, where it comes from, and why it's, frankly, so important, but also pretty misunderstood in financial reports.
Right.
We've pulled our analysis from some pretty detailed accounting guidance, specifically rules and examples from texts for advanced financial reporting exams. So the proper stuff.
Okay, so this is the real deal. And our mission for you today is pretty straightforward. We want to demystify this, take this seemingly technical accounting topic and make it accessible.
Yeah, pull out the key bits.
Pull out the essentials, yeah. And some surprising details, too, so you could be genuinely well-informed about how companies get valued and accounted for after these massive deals. Let's get into it.
Yeah.
Okay, let's unpack this. Goodwill. It sounds, nice, like good reputation or something.
Sort of warm and fuzzy.
Yeah. But in accounting, it's much more specific, much more strategic. What exactly are we talking about here?
Right. In accounting terms, goodwill is an asset, but it's a very particular one. You won't just see it on any company's balance sheet.
Okay.
It only appears when one company buys another one, gains control. Then it shows up on the consolidated financial statement, the one that merges the two companies' figures together.
Ah, okay. Only in an acquisition context.
Precisely. And under the official rules, IFRS 3, which deals with these business combinations, goodwill basically represents the future economic benefits.
Future benefits.
Benefits coming from other assets acquired in the deal, but assets that aren't individually identified, you can't really separate them out and put a value on them individually.
So it's like the extra bit, the premium.
Think of it as the intangible premium paid over and above the fair value of all the identifiable assets, the buildings, the patents, the customer lists you can value. Goodwill captures the stuff you can't easily itemize, like synergy, maybe a really strong brand, established customer loyalty, a brilliant team.
Yeah.
That kind of thing.
Got it. So it's real value, but it's hard to pin down, and it only appears after a deal. That sounds, well, different from how other assets are treated, doesn't it?
Absolutely. And this is a crucial difference. Unlike, say, a factory machine that you depreciate systematically over its useful life, or a patent you amortize over its legal life, goodwill is never amortized.
Never. Okay, that's interesting.
Instead, it has to be tested annually, tested for impairment.
Impairment, meaning has it lost value?
Exactly. And this isn't just some random accounting rule. It reflects that this intangible value, this premium, it's subjective, it can be volatile. Amortizing it would kind of imply it wastes away predictably.
Which it might not.
Right. Its value could potentially evaporate much faster or maybe hold steady. So these annual impairment tests are vital. They're like a reality check on that premium you paid.
Okay, that makes a lot of sense. So if it's not just good vibes and it's not amortized, how do accountants actually calculate it? How do they put that initial number on the books? What's the formula?
The basic calculation at the point of acquisition is conceptually pretty straightforward. You start with the consideration paid, what the buyer actually gave up.
Okay, the price tag.
Pretty much. Then you ADD the value of the non-controlling interests, or NCI. That's the part of the subsidiary the parent doesn't own. Also valued at the acquisition date.
Right, the minority shareholders slice.
Exactly. Then, from that total, you LS subtract the fair value of the subsidiary's net assets at acquisition.
The identifiable stuff we talked about.
Yes, the fair value of everything you can identify. The result. That's your goodwill at acquisition.
That's the starting point.
Yeah, that's the starting point. And then, crucially, over time, you subtract any goodwill impairment losses that have happened since then. And that gives you the goodwill figure at the reporting date, the number you actually see on the balance sheet later on.
Right, because it might have been written down.
Correct.
Okay, here's where I think it gets really interesting. That consideration paid part. It's not always just, handing over a suitcase full of cash, is it?
No. Rarely that simple in big deals.
Our sources highlight quite a few ways this happens. It's more complex than just immediate cash.
Definitely. Immediate cash is the simplest, sure. That goes straight into the calculation. But often you see deferred payment.
Cash paid later.
Right. Cash due maybe a year or two down the line. The key thing here for accounting is you have to recognize it at its present value.
Time value of money.
Exactly. What's that future cash worth today? That discounted amount is what goes into the Goodwill calculation up front. So the example our source gives is Laldico buying Biddleco. They promised $200,000 in a year. With a 6% discount rate, that's only worth about $188,679 today. That's the figure used for Goodwill.
Okay. But they still owe the full $200,000 eventually, right? What happens to the difference?
Good question. As time goes by, that discount unwinds. The liability on the parent's books gradually increases back towards the full $200,000.
Okay.
And that increase is treated as an interest expense specifically, an interest expense on unwinding of discounts in the parent's profit or loss statement.
It hits their profit.
It hits their profit over the period, but, and this is key, the Goodwill figure itself, it's unaffected by this unwinding. Goodwill was fixed at the acquisition date value.
Right. That makes sense. So the financing cost is separate. What about payments that aren't even guaranteed? Like if the acquired company hits certain targets?
Contingent consideration, yes. Future cash, but it depends on something happening, maybe hitting revenue goals or getting drug approval, stuff like that.
Okay. How's that treated?
Similar initial principle. You have to estimate its fair value at the acquisition date. What's the probability-weighted expected payout? That fair value estimate goes into the initial Goodwill calculation.
Another estimate up front.
Yes. Now, if that estimate changes later, maybe it looks more likely they'll get the payout or less likely that adjustment goes through the parent's profit or loss. It's treated like a change in a provision.
But again, not touching the original Goodwill number.
Correct. Goodwill stays put based on the acquisition date estimate. These subsequent changes reflect new information after the deal.
Okay. Cash, deferred cash, contingent cash. What if they pay with their own stock?
Very common. That's share consideration. The acquiring company issues its own shares to the sellers.
How do you value that?
You use the parent company's share price at the date of the acquisition. Multiply the number of shares issued by that price. That total value gets added to the consideration paid for Goodwill.
And that also impacts the parent's equity accounts, I assume.
Exactly. It increases the parent's share capital and share premium on their own balance sheet.
Okay. So we've got cash, shares, future promises. But what about all the costs of doing the deal? The lawyers, the accountants, the advisors, those fees can be huge. Do they get rolled into Goodwill?
This is a really important point and maybe a surprising one. The answer is no.
No, really?
Really. All those acquisition-related costs, legal fees, due diligence costs, advisory fees, they must be expensed immediately. They go straight to the parent company's profit or loss statement in the period they're incurred.
Wow. Okay, so they don't increase the asset value on the balance sheet.
Correct. They are not included in the Goodwill calculation. Our sources point out this is a common area where mistakes happen. Sometimes companies incorrectly capitalize these costs, maybe adding them to the investment cost, and that needs correcting. They're treated as costs of the transaction itself, not part of the value of the thing acquired.
That's a fantastic clarification. Okay, so we've covered what the parent pays. Now, let's flip to the other side, the part of the subsidiary the parent doesn't own. The non-controlling interests, NCI. How does valuing them affect the Goodwill number?
Right, NCI. This is crucial because how you value this slice of the company you didn't buy directly impacts the size of the Goodwill you record. IFRS 3 gives parent companies a choice between two methods at the acquisition date.
A choice. Okay, what are the options?
Option 1 is the fair value method. Here, you value the NCI's shares based on their fair value. Often this is done using the subsidiary share price at the acquisition date, if it's publicly traded.
Yeah.
Multiply the number of NCI shares by that market price.
Okay, market value. What's the implication of using that method?
The big implication is that this method usually results in a higher Goodwill amount.
Higher. Why is that?
Because when you value NCI at fair value, you're essentially including a portion of the Goodwill that's attributable to them. You're recognizing the Goodwill of the entire subsidiary, both the parent's share and the NCI's share, sometimes called full Goodwill.
Interesting. Okay, so that's option 1. What's the alternative?
Option 2 is the proportionate share of net assets method. This one's different. Here, you calculate the NCI value simply as their percentage ownership multiplied by the fair value of the subsidiary's identifiable net assets at acquisition.
So just their slice of the stuff you can identify and value separately.
Exactly. No implied goodwill for them. And the implication here is, well, the opposite. This method results in a smaller goodwill amount.
Makes sense. Why smaller?
Because it only includes the goodwill that's attributable to the parent. You're only recognizing the premium the parent paid for its share. The NCI is just valued based on its share of the underlying identifiable assets. It reflects the lowest possible value you can give the NCI.
So the parent company gets to choose which method, and that choice directly impacts the goodwill number reported.
That's right. It's a policy choice they make for each acquisition.
Okay, so we've established how goodwill gets calculated initially, shaped by consideration and the NCI method. But you said earlier it's not amortized, it's tested for impairment. Let's talk about that. It's not a static asset, right? What happens when that premium starts to look shaky?
Yeah, goodwill impairment is a big deal. This happens after the acquisition when there's evidence that the value of that initial premium has declined. Maybe the expected benefits from the subsidiary just aren't materializing.
What kind of things would trigger that concern?
Oh, lots of indicators. Maybe the subsidiary loses a major customer, key managers leave, maybe a new technology comes along and disrupts their business. Poor financial performance, obviously. Significant downturns in the economy or the specific market they operate in.
Okay, so management sees these signs, does the test, and decides, yep, our goodwill is impaired. What's the consequence? What actually happens on the financial statements?
The consequence is a write-down. If goodwill is impaired, the company must reduce its carrying amount on the balance sheet down to its recoverable amount.
Recoverable amount.
Meaning, essentially, what the asset or the business unit it relates to is actually worth now. Usually the higher of what you could sell it for or the present value of the future cash flows you expect it to generate.
And is that write-down permanent?
Yes. And this is absolutely critical. Once goodwill is impaired, written down, that impairment loss cannot be reversed in future periods. Even if things turn around later, it's a permanent reduction.
Wow, okay. No takebacks on goodwill impairment.
None, which makes that annual test pretty high stakes.
And how does this impairment loss get allocated? Does it connect back to those NCI methods we discussed?
It absolutely does. The allocation depends entirely on which method was used to value NCI at the start.
How so?
Okay, remember, if NCI was measured at fair value, the method giving higher full goodwill, in that case, the impairment loss is shared. It's allocated between the parent, the group, and the NCI, usually based on their ownership percentages in the subsidiary at the time of impairment, because logically, the initial goodwill belonged to both of them.
Okay, so everyone takes a hit.
Right. Our source has example 2. If goodwill was $2 using the fair value method and there's a 10% impairment, $200 K loss, and NCI owns 20%, then NCI absorbs $40K of the loss and the parent group absorbs the remaining $160K.
Got it. And if the other NCI method was used?
If NCI was measured at its proportionate share of net assets, the method giving lower goodwill, only the parent's share, then the entire impairment loss is allocated only to the group, the parent company.
Only the parent. Why?
Because under that method, no goodwill was ever attributed to the NCI in the first place. They were just valued based on identifiable assets. So if the goodwill, which only belonged to the parent, gets impaired, only the parent takes the hit on their share of the profits.
So in example 2, using the proportionate method, initial goodwill was 1.8 meters. A 10% impairment, $180K would all hit the group.
Exactly. The full $180,000 loss goes against the parent's earnings. NCI is untouched by the goodwill impairment itself.
That choice of NCI method at the start really has long-lasting consequences then, especially if things go south.
Huge consequences. Affects the initial balance sheet and how future potential losses are shared.
It's clear these rules really matter. Now, our sources also walk through a pretty comprehensive example. Plateau Co. acquiring Savannah Co. and Axle Co., pulling lots of these threads together. It looks complex. What's maybe one key takeaway from that big example that shows how these pieces interact in sort of a messy real-world scenario?
Yeah, that example 3 is great because it layers everything. One thing it really highlights is that crucial adjustment for professional fees.
The ones that should be expensed, not capitalized.
Exactly. The example shows a situation where they were initially misclassified, maybe added to the investment cost. It demonstrates the correcting adjustment needed, taking them out of anything related to the asset cost or goodwill, and expensing them directly to profit or loss.
So it shows the practical fix.
Yes. It's a powerful reminder that even if the theory sounds straightforward, applying it correctly in practice, catching those errors, is vital. It really shows how getting that classification wrong could significantly misstate both your goodwill and your reported profit. It connects the dots between the rule and the real-world adjustment you might need to make.
That's a great practical point. Okay, so we've covered a lot of ground. Why is really understanding goodwill important for you listening? Whether you're in finance, maybe prepping for a meeting about an acquisition, or honestly just curious about how big business works.
Well, understanding goodwill is key to really deciphering what's going on when one company buys another. It helps you look beyond the headlines and analyze the financial statements properly.
How so?
It gives you insight into what management thought they were buying, the intangible value, the future prospects beyond just the physical assets. It's a window into their strategy and expectations.
And the impairment part sounds crucial for analysis.
Absolutely crucial. Goodwill impairment isn't just an accounting entry. It can be a major red flag. It signals that maybe the acquired business isn't performing as expected, that the promised benefits aren't there. That can significantly hit reported profits and the company's overall financial health. Anyone looking at a company post-acquisition needs to understand what's happening with goodwill.
So it tells a story about the acquisition's success or lack thereof.
Pretty much. It also just highlights how much judgment goes into accounting for these big deals. It's not always black and white. Understanding goodwill gives you a much deeper, more informed perspective on the numbers you're seeing.
We've definitely unpacked quite a bit today about goodwill. It's clearly far more dynamic and insightful than just a line item on a balance sheet. From how it's calculated, dealing with all those different types of payment and the NCI choices, right through to the fact that impairment is permanent.
Yeah.
It's complex, but really important.
It really is. And this whole dive into goodwill, I think it underscores something fundamental about business combinations.
Yeah.
Often the things that are hardest to quantify,
Yeah.
the strong brand, the customer loyalty, that unique tech, that the stuff can be the most valuable part of the deal, the real prize.
But also the most fragile.
Exactly. The most valuable and yet often the most vulnerable, which leads to a thought, maybe for you to ponder. How do you think companies can best manage these really elusive future economic benefits? How can they protect and nurture that intangible value to make sure it delivers in the long term, well after the acquisition headlines have faded?